Well, first we want to thank our first sponsor, Niagara Conservation. They make the world's best performing, lowest flowing toilets, the Stealth, down to zero point 0.8 gallons per flush. That's a single flush system that works. They make an ADA side handle for that, and they have a dual flush now down to zero point 0.5 and zero point 0.9 as well. So check them out over at niagaracorp.com and look for the Stealth. And then thanks to our top tier sponsor Panasonic, they're your number one source for ventilation needs in new and existing homes. Panasonic features many different products to ventilate bathrooms right, or for exhaust only whole house strategies, includes more affordable solutions, motion sensors, timers, condensation sensors, and ERVs. Speaking of that, the IntelliBalance 100 is the International Builder Show 2017 Best of Award winner, a customizable high performance, high efficiency energy recovery ventilator that can be used in any climate to meet the ASHRAE 62 standards. It can be fully ducted or a standalone point source ERV system, going up to a MERV 13 filter in it as well, and helps really keep those energy scores low by getting that balanced ventilation in. Looking for a cheaper balanced ventilation strategy? Pair Whisper Green bath fan with a select cycler to bring in air through the furnace intake and exhaust it out the bath fan. And add in a range hood pressure sensor to activate the system when makeup air is needed during cooking. And stay tuned here because Panasonic will be launching some smart ventilation solutions that can detect poor air quality and ventilate as needed. So look out for that in the future. All right. Welcome to Using Green Choice Mortgage Renovation, free webinar. This course is approved for 1 hour in continuing ed, GBCI, AIBD, Certified Green Professional, BPI Non-Whole House, as well as AIA Health, Welfare, and Safety, which may make it applicable to your state-based design or contractor license. Today, my name's Brett Little, and I am here as the Executive Director with the nonprofit, the GreenHome Institute. And what we're going to be talking about is really just coming up with strategies to break down those barriers to financing and funding energy efficient, net zero, and green home retrofits with new mortgage packages, which makes it much more affordable these days to do that, and this new program that can really help out with that. And so I'm very excited to have Dan Tacona. He manages the affordable lending strategy and policy within Freddie Mac's single family division. He is responsible for the design and execution of single family activities related to affordable housing preservation under Freddie Mac's Duty to Serve plan, which focuses on addressing the needs of underserved markets with expanded access to manufactured housing, rural housing, and affordable housing preservation. So Dan, tell us a little bit more about what you got.
So we came up with two products that I'm happy to walk you through today. They're both renovation products. They both allow for energy efficiency features, but one of what I'm going to be focusing on is the differences between the two, when to use each, and how you can help homeowners or borrowers that are maybe looking to make improvements in their homes by leveraging these product features. So with that, I'm going to start with the Choice Renovation product. This product was meant to solve or meet the need of homeowners or first-time home buyers that have a home that is aging and that they're looking to not necessarily upgrade or move into a new home, but they actually want to just stay in place and renovate their house. Or for first-time home buyers that are looking to buy a fixer-upper, and as they purchase that fixer-upper, finance the improvements that they would make on that fixer-upper to make it their own. And this is our Choice Renovation product, which we introduced it just this past June. So it is pretty much brand new in the marketplace. And it has gotten a lot of really good and positive attention from a good majority of our lender partners that are getting calls from their customers, homeowners or first-time home buyers or to-be homeowners to try to finance homes and be able to finance the improvements in the same transaction as well. And as a point of reference, what has been happening in the marketplace, and you may know this, is when a borrower is looking to finance improvements, typically what they would do is try to do a HELOC, a home equity line. Some of it can be done through unsecured financing, or if it is a new home buyer trying to purchase a home, a fixer-upper, some of the available opportunities right now are doing a pre-construction loan, and then once the construction is completed, doing another loan to do the takeout loan on the first transaction, which entails two transactions and becomes more costly and troublesome, right? So what we were looking to do is create one transaction where both the purchase of the home can be financed as well as some of the improvements, and minimizing some of the costs that would be associated with doing two transactions. And we allow both a purchase and a refinance transaction to make improvements. It really provides a lot of flexibilities to really be able to take on quite a bit of what I would qualify as to be equity against the property, because we have created appraisal requirements that allow for the as completed value to be accounted for, which is something that in your typical transaction, when you're doing two closings, you're not accounting for the value of the property post improvements. You're accounting for the sales price of the property as is, and then afterwards you have to do another appraisal and then see if anything has changed, right? Post improvements, we have solved for that. So in general, our choice renovation is meant for 1 to 4 unit properties. We're looking to support primary residences only, or we're not looking to limit it, I should say, to primary residence only. So we do allow 1 unit second homes or 1 unit investment properties to also be financed through our choice renovation product. It can be a condo, a co-op, or at least whole state in general. And we do allow manufactured homes, but we have some restrictions on with the manufactured home, which I'll touch upon later. One of the key features of our product is that it can be used in combination of other financing offerings. So for example, Freddie Mac has our affordable product, which is Home Possible, and it allows for financing up to 97% of the value of the home. And that Home Possible offering can be used in combination to the Choice Renovation product, and which is particularly helpful for homeowners or borrowers that need the additional flexibilities to put a lower down payment, which, where the home prices are heading in relation to what we have seen in terms of increases of the median income year over year, there's a disproportion between the two, right? So home values continue to raise, and incomes are not keeping up with that trend to a certain extent. So we see more and more home buyers needing lower down payment options, which makes our choice renovation product even more attractive to those kinds of borrowers, because it can be used with some of our low down payment product offerings. The maximum renovation costs that can be financed through this product offering are 75% of the as completed value of the property. I'm going to go through an example so these two percentage numbers make a little bit more sense. But basically what we're saying is that we're asking our lenders to account for the value of the property after all the improvements are completed, and then we're asking them to make two calculations in order to meet these two different numbers. 97% for the loan amount and 75% for the portion of the loan amount that would be able to be used to finance the actual costs of renovation. And when I go through the example, this probably will resonate a little bit better. I mentioned that there are, we allow manufactured homes, um, but for the total cost of the renovations for manufactured homes only are 50% of the as completed value of the property. So we have a lower threshold for manufactured homes um, than other stick-built properties. Um, and what we're looking for the lender to do is work with their appraiser to do an inspection of the home before and after the renovations are completed. Before I start going through this slide, are there any questions that I can answer?
Well, it looks like my question was going to be more on the resiliency, but it sounds like you're going to get into that because I saw it on the last slide.
Yes, yes. So let me touch upon some of the eligible renovations. So one of the key items that we incorporated in our renovation product is that they can actually be used also for housing resilience items. What that really means is that, you can renovate a home and include items above and beyond what the home had originally. This is for an existing homeowner, let's say, in an area where that may be prone to disasters, like Florida, for example, or the Panhandle, that unfortunately not too long ago was affected by a couple of hurricanes over the past couple of years. So if you're a homeowner there and you're renovating your home, you can use our product not only to bring it back to its original condition, but also go above and beyond and include some items that would make the home much more resilient for a future disaster, and hopefully it won't happen, but you'll be protected if it does. And those items are like storm surge barriers, for example, retaining walls, things like that. And we've gotten really good feedback from the marketplace that this can be used as part of the um, um, uh, transaction, or that this can be financed as part of the transaction. Um, Generally, the proceeds must only be used to finance renovations that are made to an existing dwelling, and they can actually include items like fees related to plans and specifications, permits, title updates, appraisals, draw inspections, the final inspection, and other costs associated with the transaction itself. So the the product is not limited to the labor and material cost of the renovation itself, but also some additional fees or expenses that are related to the renovation itself. We also allow an amount up to, but no more than, 6 monthly payments of principal, interest, taxes, and insurance. We included that provision in our product to help particularly homeowners that are using our product to renovate their homes post-disaster. Um, Nobody wants to be paying a mortgage payment on a home that you're not occupying for a period of time. So we do allow that the first 6 months be included in the transaction, and our hope is that that'll provide with some flexibility for those homeowners that are renovating their homes post-disaster. It goes without saying that all the renovations need to be in compliance with state and local laws. That's something that is we would ask our lender partners to work with the appropriate counterparties that are involved in the renovation to ensure, including the homeowner. And that's something that we do check post delivery of the loan to Freddie Mac. Any questions on the eligible renovations or resiliency or anything that I just referenced?
So one question I have, in a previous slide, it said something like funding repairs from previous storms. And so I guess I just wanted to confirm that. And then if that is true, do you require that they then, while they're fixing that repair, that they then put in a form of resiliency so it doesn't occur again, or at least has less chance of occurring again?
We do not require any of the renovations. That is completely up to the homeowner to do. Um, we, you know, we say that they're eligible, but we would not be making any type of requirement as a condition of the financing.
And then just again, thinking of resiliency, do you have like a list of what those items are? I mean, I can even think like if someone's in an area, like with what's going on in California right now with high grid outage potential, do batteries, financing batteries count as a resiliency strategy under this financing?
We do not prescribe what resilience would qualify as, just because things do change. It is highly dependent on the geography in which the property is located at, and we know that there's different strategies to make a home more resilient. So we would typically ask our lenders to work with the appraiser to ensure that the items are meeting a resiliency threshold, but we don't dictate what that threshold should be, um, just because we don't want to box anybody to very specific items.
Okay, so then I assume that could even count like somebody asked, and I was thinking that too. Like, I mean, obviously one strategy is if you're having heat waves or cold issues, air sealing and insulation. So, I mean, that just sounds like
Correct.
you could,
We would consider an air sealing and insulation more of a normal energy efficiency improvement, so it would still qualify.
yeah,
Even if it is we wouldn't necessarily consider that as a resilience item, although to your
yeah.
point, it may be used as a strategy to make the home more resilient, but it would
So
fit the
another
norm.
question is, does this apply to homes that have a finished floor elevation at or below the newer FEMA flood maps?
Yes, we don't have any geographic restrictions on the homes.
Okay. Um, Great. Well, thanks. I think that's all the questions I saw here. So.
All right, perfect. Okay, so now to bring it home a little bit, and hopefully this will help you picture what a likely transaction looks like. I wanted to walk you through this quick little example. In this example, I'm using easy numbers, and we're going with a property that would be a fixer-upper property, right? That may need significant improvements in order um, to make it more livable and comfortable for the person who would be purchasing this property. And in this example, that property sales price in its as is condition would be $75,000. And what we know is that typically what's happening today, if I wanted to purchase that property, I would have to first finance, get a loan for $75,000. And then I would have to figure out how am I going to finance the improvements if I don't have the cash on hand, and take out a different loan, which would be a construction loan. And then once the construction is completed, then I have the option to, pay both independently or combine them and do a takeout loan. And then at that point, I would want to have, ensure or work towards making sure that the new transaction will fit, right? Everything that I've just been measuring, which gets complicated, costly, time consuming, and no one wants to go through that many transactions. So the way our transaction would work is, I would purchase that property for 75,000, and I would immediately start getting contractors to give me estimates of what the improvements that I'd like to make would be, and I would come up with a cost. And in this case, we're looking at 175,000 on top of the 75 that I would be paying for the property. I would start working with a lender that is offering the Choice renovation product, and the lender would immediately engage an appraiser And the appraiser will go to the property and confirm that the property sales price of the as-is condition is 75. That would be one check. And then get a list of all the improvements that are to be made and the estimated costs. And then come up with an opinion of value of what that property would be valued after all the improvements are completed. And for simplicity, we included here that the total acquisition cost would be 250. That's just simply a summation of the two numbers above. And for simplicity, we're saying that the appraised value as completed would be 250 as well. We wanted to note that this is not always the case, right? Sometimes these numbers do vary. The acquisition cost may be higher or lower than the as completed value determined on the based on the appraisal. But for simplicity's sake, we're keeping it the same. And if there is a difference in these two numbers, what we ask our lender to do is look at the loan to value based on the lesser of those two values. And I use an example where there's two differ for in the next example that I have, so that'll I can illustrate how that would work as well. For this particular example, as I mentioned earlier, there would be two numbers that we're going to be asking the lender to calculate. One to determine what's the maximum allowable portion of the financed amount that can be used for the renovations. And in this case, because the as completed value is 250,000, we will be asking them to figure out what 75% of that is. In this case, it's 187,500, which means that in this case, the home buyer would be able to finance up to 187,500 of renovations. Because the estimate came to 175, it fits because it's within that limit. So the transaction is a go. The next calculation that we're going to be asking the lender to perform is looking at what the maximum loan amount would be. And in this case, they're going to be taking, again, the as completed value of the property, which is 250, and calculating 97%, which means that the borrower will have to come up with a 3% down payment to make the transaction work. So the loan amount at origination would be 242,500, and then the borrower, home buyer at this point, will be able to go to closing and close on the transaction while be the owner of the property, and then at that point they will be able to hire contractors to start the renovation project. And the lender will be managing the draws. So every time that the contractors finish a phase of the project, they'll be able to submit appropriate documentation directly to the lender for the lender to disburse funds or pay, as the project is completed throughout. And we give 12 months for the renovations to be completed. And we have some flexibility if the renovations are not completed within a year to extend beyond that in certain circumstances that we review on a case-by-case basis. But that in general would be the transaction a lot easier because you're closing on, you're closing on one loan, so you're saving on origination costs and other fees associated with loan closings in general. And if you note in this particular transaction, because the maximum loan amount and the maximum allowable renovation cost is greater than the actual cost of improvements that are needed, the homeowner in this case would have the ability to include those 6 months of PITI that I referenced because there's room within the allowable renovation cost to be included. So that could also be factored in here if the borrower were to choose to go that route. In this case, we're keeping it simple, so we didn't incorporate any of that. But because there is room for within the allowable renovation cost, that could be an option for this particular borrower in this example. So I'll pause there to see if anyone has any questions about this example and how a choice renovation transaction would work.
Yeah, so the question is, what is the percent of each money draw?
We do not prescribe the percent of the money draw. It depends on the project. So what we'll be asking before each draw is, um, you know, let's say that the first part of the project will be the roof, right? The roof, once the roofers complete their job, they're going to have to submit documentation and a request to get paid, invoices and documentation that attests that those were completed. And then the draw would be based on that. Once the lender confirms that there is an appropriate expense, then they'll disperse the funds directly to the contractor. In other instances, a contractor may need to purchase materials before starting the labor. In that case, they would also submit documentation to the lender to draw for materials, and the amount would be based on what is needed for that particular phase of the project. And we ask our lenders to verify and collaborate that, and then if everything matches, then they'll disperse those funds. But we do not have any prescribed percentages for the draws. All right. Okay. So I will move on to the next slide. So now I want to talk about green choice mortgages. So the choice renovation product is for any kind of renovation, including energy efficiency improvements and including um, any improvements that are related to making the home more resilient for future or possible disasters. We realized that a lot of the escrow requirements that we have for those types of renovations, which are generally larger in both scope and cost, um, where it may be too operationally complicated for more simpler type of improvements like energy efficiency improvements. And an example that I typically use is if a borrower wanted to get solar panels or a homeowner wanted to get solar panels in their house, that typically is not a long-term project, multiple phases, right? It's usually a much more simpler process. Um, I've seen typically within a week, a homeowner can get panels installed so long as their roof doesn't need any additional repairs. So it's a much more simpler, process. So we felt that rather than having all of the other requirements that we would have for a more standard renovation project, where there's multiple draws, et cetera, you may need materials ahead of time and then submit a different kind of documentation, that we needed an offering that would simplify the process for those type of renovations that are simpler in nature. And we find that the energy efficiency improvements are typically that. So we created a product that is unique and only for energy efficiency improvements. So it is a very similar product that we have been marketing it as. It is a simpler renovation product that expands some of our options and offerings that we have for homeowners or to-be homeowners that are particularly interested in financing improvements that are energy efficient or that will make their home more energy efficient. So we're really looking to target homeowners or borrowers that are particularly looking to lower the utility costs and making their homes greener, I would say. So this product became effective last year, or we announced it, I should say, last year, and we started, our lenders started offering this product as of May of this year. And we have different kinds of eligible energy efficiency and water improvements. But one of the key features of this product in relation to the choice renovation product that I mentioned is that it works fairly the same, but the key difference is that instead of allowing the costs to be up to 15% or 75% of the as completed value, it is up to 15% of the as completed value. Additionally, I mentioned we do require that all of the improvements that are going to be part of the transaction are energy efficient or are of energy efficient nature. And to verify that, we asked, we have two different paths. One is if it is above $6,500, and the other one is if it's below $6,500 in total cost. If it is above $6,500, we ask the lender to work with the homeowner and appraiser to obtain a home energy audit that would rate the property and identify what are some of the cost-effective improvements that, if made, would lower the utility costs and make the home more or greener, right? And if the improvement is in the energy audit as an improvement that would be cost efficient, it is eligible for this type of mortgage. The second path that we have is if the aggregate cost of improvements are below $6,500. For that, we do not require an energy audit, but instead we asked our lenders to review the basic energy efficiency improvements that we have highlighted in our sell-in service and guide. And if it's included in that list, then it can be included in the mortgage. We provide our lender partners with a $500 credit in the fees that that we charge them when they're delivering the loans to us. And this is to incentivize the lenders to offer this product and to offset some of the costs or additional costs that they may need to do, like working with the homeowner and the appraiser to get a home energy audit, right? Similar to the Choice renovation product, it allows a single closing transaction rather than having multiple transactions. And we allow for the mortgage to be delivered to us, Freddie Mac, even prior of the improvements to be completed. Any questions on this page?
Well, I wanted to go back. Well, I don't know if you're going to have a list of items coming up on another page or not.
I will.
Okay, yeah, why don't we just save that question for that one? So yeah, it looks like a lot of them have to do with some stuff that you're going to get to here. So let's have you keep moving forward.
Okay, sounds good. All right, so here's a list of the eligible improvements that if it is below the $6,500 threshold that I mentioned, would be eligible for these type of transaction. Things like thermostats, weather stripping, ceiling fans, insulation, air sealing, water heaters, things like that, that we, don't need to get an audit to tell us that these are, will help the energy efficiency of the home. And we know that these are typically cost effective for the most part. So any of these would be able to fit within the transaction. If the transaction or the costs are going to be above $6,500, then we accept generally an audit report or an energy report that contains not only an assessment of the house, but also the recommendations on improvements that, if completed, would make that home more energy efficient. And we provide some examples of what we would accept. Number one is the Home Energy Rating System HERS report, which is a pretty robust report and is the most widely used to our knowledge across the industry and continues to grow. The second is the Department of Energy's HES score, or the Home Energy Score report, which is another type of report that it's growing, and especially in certain markets like Oregon, for example, we're seeing it more and more. Or it could be a comparable rating report or audit. So we know that some utility companies are also providing reports that would highlight some of the improvements that could be made to a house to reduce the energy consumption. So long as it has improvements listed as recommendations for improvements, then we would accept it. When in doubt, our lenders can always give us a call to check in with us, and we have a 1-800 number that they can call and ask for any type of underwriting questions, including this. It's not unique to this product, it's for any product that they're working on. We go ahead.
Well, there were some questions on the rating, unless you were, I didn't know if you were moving on from there.
The only thing that I was going to mention is that whether there was a rating required or is following our basic energy efficiency improvements, we do ask that a completion report be submitted as part of the loan file. So we ask the lender to work with the appraiser to ensure that they go back out to the property to ensure that the improvements were completed. While in Choice Renovation, we allow 12 months to complete the renovations. For our GreenCHOICE mortgage, we allow 180 days because those projects are typically shorter in scope and smaller in scope and cost. So please go ahead, you had a question.
Oh, and so you said 180, you have 180 days to complete the test out, the rescore, is that what you're saying?
You have 180 days to complete the renovations.
Okay, and then how much time do you have for the to complete the test, the post energy rating?
Well, the energy rating has to be done before the transaction can actually be approved.
Okay.
Right, because that's the vehicle that we're using to identify what improvements.
Oh, okay. So do you, I guess then maybe let me widen the question. Do you require a test in and a test out? So a pre-evaluation report and then a post?
We do not. We ask the audit to be done prior to the renovations done, and rely on the report to have made accurate projections of what those cost improvements would be.
So maybe the answer is probably no to my next question, but just to make sure, because I know Fannie Mae's program actually has some targets they want you to hit within either the HERS or the HES. So it would be accurate to say you don't have any baseline targets you want to see homes hit.
We do not at this time. We know that that both the HES and the energy rating have generally exceed the targets that you're referencing, so we're comfortable with not having a requirement.
Oh, okay. And then the question is, I don't know how stringent you get in it, but do those have to be done by a third-party assessor, or can the actual contractor doing the work, who also may be or may employ one of these raters, can they do the testing?
If the rater is qualified and certified by HERS to do the HERS rating, then yes.
They can be, and they don't have to be a third party to the contractor.
It can be the same, yeah.
Okay. And then, so I didn't know if you had anything more to add on the actual improvement items or not, but there's some questions on those too. So.
No, please go ahead.
So the first one, I think I was trying to understand what you were saying about solar at the beginning on that last slide, but now I see solar water heaters. So what if somebody wants to finance a solar power project, which will reduce their energy usage, and or if they want to finance solar right along in with the energy efficiency? So I'm not talking about a solar hot water heater. I'm talking about the electrical photovoltaics. What can they do with that?
Right. Great question. And actually, we're in the process of clarifying our requirements for that. So you'll get a little bit of a preview of what that will be, but it is consistent with what we expect today. We just wanted to explicitly say it. So for solar panel projects, the home energy rating system, as you may know, doesn't work, right? Because the energy rating system is really designed to look at the efficiency of the home, and a solar panel is more of an energy producing system, right? So it doesn't measure, it wouldn't measure anything related to the solar panel. What we do accept is we know that the solar installers would typically have a report that will compare what the cost efficiency of the investment will be. And that would meet our threshold to be a comparable rating report or audit. So we accept that. We have gotten questions about that, and that's been our response, rather than continue to manage those questions, we're going to include those on our guidelines so that it's much more explicit that for a solar panel project, a lender shouldn't be looking to utilize the HERS or HES report, that the report that typically comes along as a marketing tool for solar installers to sell the solar panel to the homeowner would satisfy our requirements. And in this case, we also provide additional requirements and guidelines for the appraiser to evaluate the property, accounting for the production of the system. So rather than using the more typical comparable sales approach to determine the value of the property, in this case, we provide guidance to look at the comparable sales approach to look at the value of the property prior to the solar panel. But then when they're evaluating what the solar panel would potentially add to the value of the property, we ask the appraisers to actually use the income approach, which is a different calculation that would account for the production value of the solar panel, which typically would make the transaction work better.
Glad you said that, and I appreciate that, because so on the, do you also ask then, and this is going to be another question I'm going to get into about the appraisers, but maybe we can get to it now since you said it, but would you then also be asking the appraisers to look at the income approach to the energy efficiency cost savings as well to make sure they're accurately accounted for?
Yes, we do not require that they use certain methodologies. We try to make sure that we find the right balance between providing the right level of guidance while preserving appraiser independence, right? So it is ultimately up to the appraiser, his or her expertise, to determine how to most appropriately determine the opinion of value of the property. But we provide guidance as to what are the different methodologies that we would accept to give the appraiser and the lender confidence that if they use the various tools that they typically have available to them, would meet our expectations and would be an eligible loan to be sold to Freddie Mac.
And so again, so if someone is using solar, you recommend they use the income, but you don't require it even on the solar aspect?
Correct.
Okay. And one thing I wanted to go back to that you stated, just to clarify, because we do a lot of home energy ratings and home energy scores. To be clear, the home energy rating system, or HERS, actually does have a way to track solar and get pretty detailed with it, and put in different facing directions and orientations for solar. It's not perfect. And the home energy score actually has an even smaller, it just lets you put in one solar size, but it doesn't let you dictate what direction they're facing, which is, makes it a little bit less accurate. But I did want to just clarify that those two systems both do have solar inputs. But to be clear, even with that being the case, you'll still want to be looking for a more robust solar report from the installer, correct?
That is correct, because typically they would have information that is above and beyond what would be included in either the HERS or the HES report from the appraisal's point of view to utilize the income approach methodology.
Okay, and we have a guest here who's just kind of saying, and maybe this makes sense to you, they're saying, tell me more about the levelized cost of energy in regards to the solar. And I don't know if that means anything to you, if you can answer that.
Are we saying, I'm not sure I understand the question actually.
I don't really either, so I'll have to ask the attendee to maybe ask the question a little more fully here. So I didn't know, there's a lot of questions coming in here, because with new construction, we still run into a lot of barriers where it's very difficult to finance projects like this because, again, the lack of education and awareness and comps on the appraiser side. So
Correct.
what can you do with this program for a new home for folks who want to build above the code and can show it in the HERS rating? Is there any opportunities for them?
So let me make sure that I do understand the question. So this is the scenario is somebody looking to buy a new home and then improve the home even though it's a
No.
new home? No. Okay.
No. Somebody's starting fresh and getting a mortgage for a new home, but running into the barrier of they want to have a green home, they want to have a very efficient home, but they can't get the conventional appraisal to work. Can they use a program like this to help, boost that during the construction process?
Right. So we actually have not seen that in new construction, the appraisal is as big of an issue, or really an issue, as in it is on existing construction and aged inventory, where there is more variation on the potential of value of the property. On new construction, what we're seeing is that the appraisal challenge is not any different or much different than what we see on non-energy efficient new construction. A developer will always price the property above what it may be a marketable value for the market, right? So there may be a difference there. At the end of the day, they're trying to maximize their profits, right? We don't see it any different in the energy efficiency space.
So I guess again, even setting all that aside, could somebody who's building a new home and runs into an issue, could they use this, or is this only for renovations?
This is not limited to renovations, but the majority of the flexibilities that we have are meant for renovations. So if there was a newly built home where the borrower is not looking to do any type of renovations above and beyond what the existing home is or has, then they can certainly use it, Green Choice mortgage, but there wouldn't be no added benefit to them.
Okay, so they couldn't use it during the construction process to again to boost the amount they could borrow to build that home.
No.
Okay.
That would be a construction loan. Yeah.
Okay, so it can't be added into that, but they could probably use it for if they're having trouble financing the solar, they could then just add in the solar later with something like this, right?
That is correct. What we have seen is that some of our lender partners are using it for that, marketing it as a product that can be used to purchase a new property that you add solar to it. California, for example, right? There's a lot of enthusiasm and demand for solar, so that's a geographic area where this is being used.
And some more specific questions. When do you actually, for window efficiency, do you actually have to physically buy a brand new window? Because there's a lot of strategies you can use to repair windows or change out the glass or add in exterior or interior storm windows or casings that make windows better without the full expense of a new window. Are those allowed under this?
It depends, right? If you're just sealing the outside of the windows without changing the window itself, then it could qualify under basic energy efficiency improvements. If you're doing things like changing the panels of the windows, but not the actual frame of the window, I actually don't know how much that would cost, but it may actually trigger, depending on how many windows you have in the home, trigger the 6,500 threshold in which an energy report would be required, and we would be looking for the report to have the improvements highlighted for them to qualify.
And then what about people who want to do, they want to change where their windows are because of it's more of energy efficient or using passive solar heating or cooling strategies, by moving where windows actually are, could that be financed in this?
If it is included in the audit report, yes.
Okay.
What we don't want to do is having the borrower make those decisions, because on average, your average homeowner doesn't have enough information or expertise to make those decisions, right? So we don't want somebody in, let's say, Seattle, Washington, for example, spending a lot of money on a solar panel, they may not be able to get the benefit of that as if they were in somewhere like San Diego, California.
Well, that's a great point, and I'm glad you brought that up, because there was another question about, besides the energy rater having their credential, what other what other requirements are there of a professional, or could you have a homeowner be the one who? And sorry, I'm getting a lot of feedback from you right now. Can you still hear me?
I can. I had my phone on mute. But I don't know who.
I think it was your colleague there. I think somehow she got unmuted. Anyway, so what I was saying is, basically the question is, what if you've got a really good do-it-yourself homeowner? Can they do this, or do they have to, besides the certified energy rater, is there any other kind of professional, licensed professional that has to be involved?
We do require for any improvements to have a licensed professional do the improvements. So in your scenario, the homeowner would need to be a licensed professional, and the report would have to support that the improvements that he or she is making
Right.
are energy efficient.
Right. And then the other questions were for both loans, Green Choice or Choice, if someone is doing an energy audit, can, a lot of times, especially a lot of folks can't even afford the energy audit, so can that just be financed right into the loan itself?
Yes.
Right. And also on the reappraisals for both of those, then do those add extra costs, or are those secondary appraisals just part of the normal package?
It depends. We do not, that it depends on the appraiser and whatever they negotiate with the lender.
Okay. I think those were sort of the.
Great. Well, let me go into the next slide so that I can go through the example. In the interest of time, I'm almost done here, and then we can open it up for more questions. So this example looks fairly similar to the example that we just went through. In this case, the property is, it's a livable property. It's completed. It doesn't really need major repairs or improvements. The improvements that are being done are energy efficiency in nature. And for this example, we're looking at a $250,000 property, and we're looking at about $25,000 worth of improvements to be made. Everything that is included in that cost will have to be supported by an energy audit, because it is above our threshold for an energy audit. So long as those improvements are included in the audit as recommendations, then they would qualify. And then we're looking at the total acquisition cost in this example to be $275. For this example, we're gonna assume that the as completed value doesn't come up to be exactly the same as the total acquisition cost. And as you probably know, some energy efficiency improvements are not dollar per dollar, additive to the value of the property, but they do add some value to the property. So for this example, we're saying that the as completed value is 270, even though the total acquisition cost would be 275. So there's a $5,000 delta. In this case, our loan to value requirements are the same as the Choice renovation product. So the LTV would be based on the lesser of these values. And in this case, we're looking at 270,000. So the maximum allowable renovation cost for this particular property would be $40,500. That comes up to be 15% of the 265 price of the property. And actually, there's a typo in there, so I just noticed it. But it would we're looking for 55% of the as completed value of the property to be the max, and that would, because the cost of improvements are within that amount, then the transaction, it's a go. Then the second calculation that the lender will have to perform is looking at the 97%, and it is a similar calculation than the Choice renovation. We also allow up to 97% of the loan to value with a 3% down payment from the borrower. So in this case, the maximum loan amount would be $261,900. I'm realizing that some of the numbers may not line up, but the spirit of the example is there. So that's how this transaction would work. The key differences would be the 55%, right, is different than the 75% threshold. And the Choice renovation product, the improvements can be done over a 12-month period, maybe a little bit longer if needed on a case-by-case basis. In this example, the improvements need to be completed within 180 days from the note date. So from the time the transaction is closed, those improvements will need to be made within 180 days. In both renovations, we ask for an appraiser to look at the property as is and the property after the completions and provide a report, and that needs to be included in the loan file. And in this case, this transaction can be sold to Freddie Mac prior to the completion of the renovations, which provides more liquidity to the market, liquidity to the borrower to turn around and make another loan. So I'll pause there to see if you have any questions.
Nothing specific to this.
Okay, great. All right. So I mentioned this at the very beginning, but I'll just re-emphasize that both products can be used with any of our other mortgages, which includes our low down payment options. And those are our Home Possible product, which is a 97% product that is meant to help borrowers that may have lower to moderate incomes. Our Home One mortgage product, which is another 97% loan product that is meant for first-time home buyers. And our HFA Advantage product, which is also a 97% loan product that is offered through our housing finance agencies and can only be offered through our housing finance agencies. And last but not least, this may sort of address, I think, or add to the response that I had earlier. Sweat equity can be applied to the down payment and closing costs, meaning that for these 97% products, if the borrower doesn't have quite 3% to put down as a down payment, and the borrower is able to make some improvements to the house, being a licensed contractor, or being able to show that they are licensed to perform whatever improvement they may do, and that improvement happens to add some additional equity to the property, we would count that equity as part of the down payment. And that we have seen the usage of that, particularly with our Home Possible product, when the homes are being purchased through organizations like, for example, Habitat for Humanity, that employs a lot of sweat equity to come up with or make those homes more affordable. So with that, here's a little bit more information about these three products. The key difference between these three are that Home Possible is for particular borrowers that may have lower incomes. It also has more flexible down payment requirements and closing cost funding options. Home One is for first-time home buyers. It doesn't have any type of income restrictions, and our HFA Advantage can only be deployed through our housing finance agencies, but it is based and grounded on our Home Possible product. So with that, if you want to learn about more information about any of these products, you can go to freddiemac.com, and within our website, we have a lot of fact sheets, FAQs, term sheets if you're a lender to look at the underwriting parameters of all of these products, and much more details above and beyond what I mentioned today on each of the products. You can also get tutorials that are webinars based, that are going to much more depth into each of these products, or you can sign up for training that we offer for free to our lender partners and other organizations. So with that, I think we have some time to take any questions, Brad, so I'll turn it back to you.
Yeah, great, Dan, thanks. We got some time for questions, and right before we get to those, for those of you looking for your Con Ed and listening live today, take that survey that pops up, or the same survey is sent to you in the email. Make sure to only take it once. Even if you don't need CEUs, please take it. For those of you listening to this in the future on demand, take the quiz with an 80% passing rate. Again, the quiz is only for those of you listening to this in the future, not here today live. And then follow the instructions whether you're taking it on our YouTube channel or USGBC. For YouTube users, head down to that little YouTube logo under the video. Head down on the left there to the Show More tab, expand the comments, and then go ahead and click on the little link that you see to take the quiz. Take that, submit it to us, and you can get your CEUs that way. And we got some questions rolling in, but let's get to those here soon. And I want to say a big thanks to our volunteers, our board of directors, all of our members, and a huge thanks to our sponsors, especially our top tier sponsors, T-Stud, structurally insulated framing systems that save money behind the walls, Mitsubishi Electric to go net zero today, all electric, comfortable that works in cold weather climates, Panasonic ventilation for your ventilation needs all the way down from code to new smart ventilation tech, as well as Shrinergy for on the go or in your home solar backup battery solutions. So yeah, we got some questions coming in, and I have a couple more questions on my end, kind of going all the way back here. What about container homes with either of these offerings? Where do those fall? Are those manufacturing? Can you finance those at all? Is that even on your list?
Container homes. So I know that phrase gets used somewhat loosely, and I don't know if there's a very specific definition of it. All of our homes need to be titled as real property. So if there's a container home that can be titled as real property under the state laws and federal laws, then it is eligible for sale to Freddie Mac, or the loan is eligible for sale to Freddie Mac. If it is not considered real property, then it cannot be financed through our product.
Okay. And for either product, are there caps, either floors or caps, on the length of time of how long you've owned the home that you can use either of these?
No.
Neither. Okay. And just to be clear, both on the GreenCHOICE and the renovation, you have to, I assume you have to comply with all laws and permits to use your financing, or are there any other, if someone's running up into a permit issue, does that then reduce your chances of being able to finance?
It has to follow all local, state, and federal laws.
Yeah. And I mean, on the appraisal end, I mean, it's really sounding like, and a lot of the comments coming in about having to really need a savvy appraiser. Even some are going far enough to say a certified green appraiser, which is typically through like the Appraisal Institute, who has a formal program. So, correct. I mean, what are your comments on that? And do you have, we talked a little bit about it, but do you have any other further guidance or trainings or, recommendations for
yes.
what kind of appraiser to work with, especially in the fact that you really don't get to pick your appraiser? So,
correct. Yes. So we actually have a general requirement that is applicable to all of our mortgage products, that the lender has to find an appraiser that is that is qualified to appraise the particular property that he or she is appraising. So whether it's a leasehold, an energy efficient property, we delegate and require lenders to find the appraisal that would be a best match to that qualifications, right? So typically they would put out, here are the requirements for the appraiser that I'm looking for. Even though they cannot pick the appraiser, but they put the requirements and confirm that the appraisal that is that is being chosen is meeting those broader general guidelines. In addition to that, Freddie Mac has partnered with the Appraisal Institute to fund and provide additional training to appraisers at large. And we're actively working with them and partnering on training events that we're doing. And to get access to those training events, any appraiser can just go directly to the Appraisal Institute's website, and get through any of the training events that are particularly targeted for residential appraisals. And they have an entire curriculum. 3 classes are required to get into their commonly known as Green Appraiser list, which is on the Appraisal Institute's website, and you can find appraisers that are qualified to and have taken the classes and course, is to use some of the methodologies that they have designed to help appraisers determine the value of properties that have energy efficiency components, which includes the Appraisal Institute's Green Addendum, which is an addendum to the appraisal form that captures more information and data points about a property that are energy efficient.
Great. And if local organizations or institutions want to have one of those trainings done, do you partner with them? Can they reach out to you? How does that work?
They would typically reach out if it's related to training. We work behind the scenes with the Appraisal Institute. They can reach out directly to the Appraisal Institute. You know, they have, they are the ones who carry it out. We just work with them in partnership to do so. So they would have to reach out directly to them.
Is there or will there be searchable databases by states or cities to find the lenders who are participating?
We will have, we are working, I should say, to have sometime next year lists of lenders that are participating in some of these products. The GreenCHOICE offering is available to any lender. The Choice Renovation offering, you have to be approved by Freddie Mac to be able to deliver the loan prior to the completion of the renovations. So for that, for the Choice Renovation product, as I described it, we were looking to have lists of lenders so that it's easier to find them. But generally, you know, it's easiest to just contact directly the lender itself or a lender itself, because especially some of the larger lenders may only offer in certain geographic locations, and that's part of their strategy or how they plan to deploy it, and sometimes we don't have insight into that.
You say any lender can use GreenCHOICE, and I see there was a $500 sort of reward for each one that gets through. But when
Correct.
you say any lender can use it, there's nothing extra they have to do. They can just start using it today, or does it require any extra labor on their end other than knowing how the program works?
Nope, any lender can use it today.
Wow. Another question is, are there any limits on the amount financed? So not percentage wise, but could you get a $3 million loan, for example, if the appraisals were there?
Neither of the government sponsored enterprises do $3 million loans. We have loan limits that are chartered by FHFA. And even in some of the high cost areas, we do not offer that loan amount on any product.
Okay. And the GreenCHOICE one, you can use that one on 4-unit projects as well?
That is correct. And they will have to meet the limits on the 3-unit or 4-unit loan amount limits. And those are posted on Freddie Mac's site. They're also posted on FHFA's site, yeah.
Right, so those loan amount limits changed, I assume, depending on how many units there are, correct?
Correct.
Yeah. And then another issue a lot of people run into is the utility companies and sometimes the local munis delay out solar panel activation for a very long time. So at what point do you have to see that be completed for the loan to take effect? Could it just be installed, or does it actually have to be up and operational on the solar side?
Our loan would finance the installation and related costs. So that's what we're verifying for. So long as it is installed and ready to be operational within 180 days, it is eligible for our mortgage. Now, I believe the scenario that you're mentioning is more typical for when the solar panel is being leased, not owned.
Oh, yeah. We've seen plenty of delays on owned solar panel systems from utility or muni, to be sure. But yeah, but that's good to know that you're not really looking for the system to be up and running. Obviously, everyone wants it to be as fast as they can, but that's helpful. So, do you have just then your conventional rates that are contingent on a credit score, and are they competitive?
Say that one more time. I think I lost you for a half a second there.
So there's a question here on just the rates, and so again, are your interest rates just like any other mortgage, contingent on the credit score, and then also are they hyperinflated rates, or are they pretty competitive with conventional mortgage rates?
Freddie Mac does not set rates for mortgages. Each lender has their own pricing methodology, and they're at liberty to make pricing based on however they're managing their own risk. Generally, pricing is influenced by the quality of the mortgage, meaning collateral, credit, capacity, FICO scores, incomes, etc. But we do not govern rates.
For those who are getting, like, if it's solar, you get sort of a tax credit kickback maybe that next year, the next 2 years, or sometimes utility companies give out a bunch of rebates once these systems are installed. So can either of those be rolled back into the principal and reduce the amount on the mortgage payment? Is that an opportunity or something you're looking into at all?
No. The borrower or homeowner is at liberty to, at any time, prepay their mortgage.
Right.
In order to reduce the mortgage payment, that would have to be recasted, and they would have to call their servicer to see if they can recast it. And typically, that would entail a refinance transaction. You don't just recast your loan.
Right. You can't recast it with a utility rebate at no cost or
Right.
no.
Right. But you can always
Okay.
pay it down. Just like a tax,
Right.
a rebate. There's
Sure.
no prohibition.
Here's a great question that came in. How do you or don't you, if at all, and these are very rare states, obviously, but it's growing, work with property assessed clean energy loans?
We do not allow it. And this is not something that it's unique to Freddie Mac. It's actually both government and sponsor enterprises. It was at the
Okay.
direction of the Federal Housing Finance Agency because of all the controversy around PACE loans and the likelihood of being or having been predatory lending in many instances. So, if anything, if a loan that we currently own in our books as the investor, we become aware that they have a PACE financing, we would ask for a repurchase, and that is not eligible to be sold to Freddie Mac. We do provide flexibilities for those borrowers that would like to keep, conventional financing to pay off that PACE obligation through a mortgage. Freddie Mac and GreenCHOICE can be used for that, but we have many different other products that can be used.
And then the last question here is, I just wanted the clarification on that sweat equity piece, which I think is really cool. Can that be fully used to pay for all the down payment? Or was it just a portion of it?
100% of the 3% on a home possible mortgage can be used or can come from sweat equity.
And those home possible can be merged with GreenCHOICE, right?
Correct.
Yeah. Great, Dan. Well, we're at our time, a little bit over. Thanks for sticking around. I don't see any other questions. So before we wrap up, where can people go to learn more and get started if they're interested?
Yes, FreddieMac.com. Click on single family business, go to our products page, and that's where you can start.
Perfect. Well, Dan, I want to thank you and your whole team for working with us to get the word out about this. And thanks for your time. Thanks for joining us, and Freddie Mac as well. And have a great rest of your week, everyone. Take care.
Thank you, everyone.